At the most basic level, one needs to try to understand what a value discipline is trying to execute. All you're really trying to do is two things. You're trying to have a margin of safety in the stocks that you're buying, and you believe that price, the price that you pay, is a very important determinant of the ultimate success potential of an investment. Historically, value is a superior discipline because the expectations that were embedded in value stocks were low, and the expectations conversely embedded in growthier names were high. And those expectations could be quantified by low multiples, low PE, low price to book, low price to cash flow. People just weren't expecting very much, and so if a company stubbed its toe or had some other business development that wasn't very positive, the downside was very modest as compared to growth names. Those statutory characteristics associated with value have evolved, however, and I'm frankly not totally sure why it has been as unsuccessful, relatively speaking, this decade. I think some of it has to do with market efficiency, and as the markets have become more efficient, those low multiples of earnings and book, they're more of a verdict on how the market assesses a company's commercial potential. If the market that they serve is ultimately too competitive, if there are structural impediments in terms of the nature of their business, if the business is ultimately just not able to grow because their end markets are not able to grow. So any value investor struggling with this over the last 10 years has needed to think about their process carefully and evolve their thinking. To us, the margin of safety is present in the business qualities. You need to have good returns on capital. You need to have some durability associated with those returns on capital. Now, there's a lot of businesses out there that have those characteristics that are priced up there, and we're not able to make a value argument for those, and that leaves some of the market that we can't access and have it be consistent with our discipline. But there's still plenty of stocks out there that do have a margin of safety, that do have qualitative characteristics and quantifiable characteristics in terms of their return profile that you're not paying a demanding multiple for. And I think that's how a value discipline has to evolve presently. In the current market, I think ultimately a value temperament and philosophy can be successful. One has to be mindful of what are exigent realities, as I just described, and ultimately be patient. A value discipline inherently is a patient discipline. Part of what you're capitalizing on is that a lot of investors are impatient. They're looking to make returns as soon as possible. They're looking for product developments and financial results that are going to happen as soon as possible. Value investors, whatever your stripe, relative, deep, quantitative, at some level you tend to be willing to defer gratification in order to get that superior price at the point of purchase. Sometimes it can be because there's a new product, maybe there's a controversy in the end markets, maybe there's some financial performance that needs to improve, and you may not yourself totally know when those variables are going to improve in a more favorable way as far as your investment is concerned. So that time and that uncertainty is, with respect to time, those are the things you're arbitraging as a value investor. Philosophically, there aren't that many ways to go about beating the market. You need to be right more often than you're wrong. If you're wrong, you need to be wrong small. And ultimately, you need to have some focus in terms of the investments that you're in, and that they are indeed going to be superior investments and opportunistic as the opportunities come to you. It's not that hard of a formula. I think one of the challenges in the bull market of the 2010s is that the overall field of investments has done very well. And I liken it to a golf tournament where you're up against a bunch of seasoned pros. Just to stay in the hunt, you've had to be really, really good. There have been other markets, and the market of the 2000s was like this. The big names, they were poised to disappoint. Valuations were high, some of the business models were not as bulletproof as people thought, and that was a market that it was not that challenging to outperform. Are we setting up for one of those in the decade of the 2020s? We'll see, but I like our odds.